Hey, welcome to the desk. So it's your first day as a corporate finance intern, and you're probably looking around this floor wondering, how on earth do we actually figure out what a company, a project, or a stock is really worth? Well, consider this explainer your official day one orientation. We're going to walk through the ultimate valuation toolkit together to help decode the numbers behind all the big decisions. All right, let's dive right in.
Here is your day one orientation map. We'll be looking at 1. The valuation toolkit, 2. The Swiss Army knife, 3. Setting the hurdle rate, 4. 2 costly hurdle mistakes, 5. Finding the optimal mix, and 6. Valuing across the life cycle.
Starting off with Section 1, the Valuation Toolkit. These are your foundational concepts.
Simply put, valuation is pretty much the foundational goal of everything we do here in corporate finance. It's just the process of assessing business fundamentals and market prices to determine what an asset or an entire company is actually worth. Literally, every time a company decides to build a new factory, acquire a competitor, or issue dividends, they are relying on a valuation to guide that choice.
Now, there are two primary ways we get to that value. Think of it like real estate, right? If you want to price a house, you can use relative valuation. That's where you look around the neighborhood, find comparable assets, maybe another house of the exact same size that just sold, and standardize the price per square foot. It's quick, it relies on market prices, and it reflects the current mood of the market. But if you use intrinsic valuation, you're acting much more like a home inspector. You're looking at the internal building materials, the fundamentals, the expected cash flows, and the foundational risks. Both of these are absolutely crucial tools in your kit, but they ask very different questions.
Moving on to Section 2, the Swiss Army knife, or as it's formally known, the cost of capital.
To quote the renowned finance professor Aswath Damodaran, there is no number in finance that is used in more places or in more contexts than the cost of capital. It really is the ultimate multi-purpose tool. It acts as a discount rate when we value whole businesses, and it also acts as an optimizing tool for figuring out exactly how much debt a company should take on. It is quite literally the Swiss Army knife of finance.
All right, let's look at the ingredients. Now, please don't let the math panic you on your first day. The cost of capital is simply a weighted average. When a company raises money to fund a business, it really only comes from two places: equity, which is stock, and debt, which is borrowing. The cost of equity reflects the risk investors see in the business. The cost of debt reflects the default risk lenders perceive. We just multiply the cost of each by how much of it we're actually using, those are their weights, and adjust the debt for tax benefits. Boom, that's your cost of capital.
Next up is Section 3, setting the hurdle rate. This is how we go about judging investments.
You see, every business on earth faces the problem of scarce resources. You only have so much money and so many hours in the day. So when a new project crosses your desk, you always have to ask, how do we know if this is actually a good investment? What separates the real wealth-building projects from the ones that just destroy value?
Well, this is exactly where the cost of capital becomes a hurdle rate. Think of it like a high jump bar at a track meet. For a project to even be approved, its expected returns must clear this bar. Some managers prefer an accounting test, where they make sure the return on their capital is greater than the cost. Others prefer looking at cash flows over time. But regardless of the metric, the standard remains exactly the same. You have to beat the cost of capital to keep investors happy.
Which brings us to Section 4, 2 costly hurdle mistakes. Let's look at some common rookie errors you'll want to avoid.
Pay attention here, because these are the big ones. Mistake number 1, using a blanket cost of capital for all investments across a company, even if those business units have wildly different risk profiles. And mistake number 2, funding a specific project disproportionately with debt and computing the hurdle rate just based on that specific debt ratio. You do not want to do this.
The crucial point here is summarized perfectly on this slide. If you use the cost of capital of the company as your hurdle rate for all investments, risky investments will be subsidized by safe investments. Seriously, think about it. If a safe grocery store chain starts investing in high-risk tech ventures but uses their low, safe grocery store hurdle rate to evaluate them, they're going to approve terrible tech projects. Over time, that cross-subsidization makes the entire parent company fundamentally riskier. You absolutely must match the hurdle rate to the risk of the specific investment.
Let's move on to Section 5, finding the optimal mix. This is all about minimizing funding costs.
Look, a company's capital structure is really just a pie divided up between debt and equity. It's that simple. Our goal is to find the exact mix that minimizes our overall cost of capital.
Why? Because when we minimize our funding costs, we maximize the value of the business.
But finding that perfect slice size is a real balancing act. Debt is generally cheaper than equity, and the tax code often allows companies to deduct interest payments, which gives debt a huge tax advantage. But there is a massive drawback. Replacing your equity with debt increases your default risk. Furthermore, financial leverage magnifies your business risk, making your equity earnings way more volatile. So as you borrow more, both the cost of your debt and the cost of your equity will eventually start to rise.
Finally, let's hit Section 6, Valuing Across the Life Cycle, where growth meets value.
Let's compare the corporate life cycle of two recognizable names here. Take the Airbnb of 2020 right at its IPO and compare it to Alphabet or Google in 2023. Airbnb was a young growth company. It was money-losing, so it had very little capacity to take on debt, meaning the debt ratio and their cost of capital was naturally very, very low. On the flip side, Alphabet is a mature, highly profitable juggernaut. It generates massive, stable cash flows, meaning it can sustain a much higher optimal debt ratio to capture those tax benefits we talked about.
The major takeaway here is that a company's optimal weights for debt and equity are naturally going to evolve. When you start your valuation on a young startup, their risk is high. Their cost of capital might start out extremely high, let's say around 11%. But if your financial models project that this startup will actually survive, mature, and become profitable, you have to dynamically adjust that rate over time. As it grows up, that 11% will naturally decline toward the broader market median of about 8%. So, my new intern, as you look at the next big IPO crossing your desk today, I want you to ask yourself, what financial risks are really hiding beneath their cost of capital? Are they funding risky ventures with safe money? Are they relying on short-term debt for long-term bets? Well, armed with this toolkit, you now have exactly what you need to look past the hype and calculate what the business is actually worth. Welcome to the team. Let's get to work.